Hi everybody, welcome to another video of What's Moving the Markets. Today we're going to talk about Mr. Trump's nomination for Treasury Secretary, which is Mr. Scott Bessent. And Mr. Scott is a hedge fund manager. He was a partner at Soros, then he started his own as well. And he's somebody who you can see being confirmed by Congress as well, right? So the nomination doesn't mean he becomes Treasury Secretary. Of course, he has to be confirmed by Congress, but it's highly likely that he will get confirmed. And if he does, then what you will see being unfolded is something called the 333 plan, which means number one, fiscal discipline. And what that means specifically is cutting the budget deficit to 3% of the GDP. Now, how? Is he talking about reducing government spending, increasing tax revenue to cut the budget deficit? No. What he's talking about is increasing the size of the GDP so the deficit becomes a smaller percentage. And how is he talking about growing the GDP? Through infrastructure spending, right? So number one, we are going to see a lot of infrastructure spending most likely. And what I would like to take you through today is some examples, not investment advice, just for your learning, that some examples of stocks and companies that could possibly benefit from this type of infrastructure spending, number one, and also the tariffs, right? So something that promotes local US made machinery and US equipment, which will benefit from the infrastructure spending. So we'll have a look at that. The third three of this 333 is energy independence. So 3 million barrels of oil or equivalent to be produced daily. Now, why I again would like to take you through some company examples over here within the energy space as well, is because not all oil companies will benefit, right? You need to know what energy independence means and what type of companies are expected to benefit under this 333 plan. And then finally, obviously your financials, your banks, insurance companies are expected to benefit from all of this. And this is something we have discussed many times before as well, that with the higher tariffs, domestic prices will go up as imported items costs for the local importers goes up as tariffs are placed on them. And because of that, higher inflation, the Fed will have to keep the interest rates higher for longer. So obviously banks are definitely very well positioned, plus the deregulation that is expected to happen. Again, the GDP growth is not only expected from the government spending but also from the deregulation. So banks again are expected to see leniency in their capital requirements, which means they could go for share buybacks. But why I would still want to focus more on industrials, materials and energy is because, see, there could be that the labor market weakens, the economy weakens because of the tariff situation and the entire global reaction to US tariffs. And that could mean that you might have a weaker labor market. And if that happens, then you might even see the Fed having to cut interest rates to stop a recession from happening. So this is a risk, right? Your financials, even though they are very sweetly placed, but there is still a risk. What I think is the lowest risk play is number one, your energy, because number one priority of this administration seems to be energy independence. They really want to be energy independent, and therefore you could see some oil companies, both production and refining, benefit from this 333 plan, and we'll be talking about that in detail. The second thing I think which is very low risk is industrials, right? And again, what type of industrials are we talking about? I will show you some examples. Materials and financials are having some risk in them, right? So materials, there is an AI play here. We've talked about it before, we'll talk about it again. So if you want to take an exposure in that, you can, but it's relatively higher risk than industrials and energy. All of this, by the way, is included in the Dow Jones Industrial Index. So obviously your industrial is the biggest part of the industrial index. You've got your financials, you've got your energy, you've got a small part of materials as well. And the entire Dow Jones Industrial Index is outperforming. You can see it is in the leading quadrant in the relative rotation graph. So clearly that entire thing is outperforming the market. But you have to look deeper into it sector wise, right? So let's talk about industrials first. So with these tariffs coming in and supporting your local companies, plus you put that together, so the domestic manufacturing incentives, put that together with the infrastructure spending, and what you get is these local equipment manufacturers such as Caterpillar and Deere being very, very sweetly placed, not just for construction equipment, right, heavy machinery, but also for agricultural as well, that as you get incentives for domestic manufacturing and you combine that with government spending into infrastructure, you can see a lot of benefit coming to players like this, right? So again, not investment advice, but just to give you a direction in terms of what type of companies could benefit within this space. And it's very, very safe in terms of there's no multiple different scenarios here, right? I mean, what I see is the new administration is very well positioned to not compromise on supporting the domestic manufacturing and also going for a growth oriented fiscal discipline. So you're going to see spending. It's just that they are going to try and increase the GDP so that the deficit remains a smaller percentage of GDP, but you will still see spending, and you will see that spending trickles down to domestic manufacturers. So that's your infrastructure, right? Energy, again, I think it's a very, very safe position to be in if you choose the companies intelligently. Now, you have to understand what energy independence means for the US, right? US exports oil and then imports oil again. Why? Because the local shale is sweet crude. And this is something we have discussed before, but you must really understand this. And majority of the refining capacity in the US is sour crude. So that's why you see that they export the sweet crude and then they re-import separately sour crude and then refine that and sell that locally. So energy independence means that number one, sweet crude production goes up, and number two, refining of sweet crude goes up so that there is no need to import sour crude, right? So who is this good for, this energy independence policy? It is good for the sweet crude product producers such as Pioneer Natural Resources, shale gas or sweet crude producer. Number two, sweet crude refiners. Who is this bad for? Sour crude refiners, right? So again, I mean, you can possibly take an exposure in a giant like Exxon, which is everywhere. It's in sweet, it's in sour, it's in production, it's in refinery. So it's there up downstream everywhere. You can take a high level exposure, or you can take a very focused exposure into shale producers, and which is sweet crude and sweet refiners as well, right? And I feel that the US administration is just not going to compromise on this anymore. They've just had it. They've had it with the sour crude import lobby. They've had it with those guys trying to stop this energy independence from being achieved, because now it's not just a matter of economy, it's a geopolitical major geopolitical factor. And what you will see is that, again, very low risk that there is going to be another different scenario here. So you are looking at a very, very highly likely scenario that energy independence stays on top of the agenda, which means sweet crude producers and sweet crude refiners are expected to benefit. Again, not investment advice, but this is a direction that you can do research in. Now, materials is not as safe as industrials and energy, given that you pick out the companies in industrials and energy very carefully. But even if you pick out companies in materials very carefully, it's just not that safe, because here you still have different scenarios. And let me explain. See, here the whole play is AI oriented play, right? And what does that mean? This is something we have discussed before, that the money goes to application providers like ChatGPT, and ChatGPT then pays it to whoever provides the data center for it, and then the data center pays it to the utility company. Now, the utility company, like we've discussed many times before, is getting their production through coal and natural gas, and they have zero emission targets, so they should move to renewable and cleaner sources, right? So renewable could be solar or wind, or cleaner could be nuclear. But this new administration obviously doesn't care that much about emissions, right? They are still okay with fossil fuels. So you might not see that much push towards renewable or even clean. Therefore, materials is not that safe compared to industrials and energy. However, even if we focus on production of energy, irrespective of whether it's clean or not, right? Even if it is coming from fossil fuels, there is still a huge transmission gap, in the sense that the places where the electricity is produced and the places where it is consumed in terms of the data centers, they are not in the same place in many cases, right? So there is a huge need for building transmission infrastructure, and that, of course, is in line with our infrastructure spending and in our local domestic producers of equipment for that infrastructure, but also you need materials. So copper, locally produced copper, right? US mining of copper is probably a much safer option, because you will need copper for that transmission. Plus, if the renewable is there and the clean input is there, so of course that just makes it more sweeter. But even if it is not there, and the government says make the electricity regardless of whether it's clean or not, but you still need the transmission, right? So that infrastructure development will obviously benefit copper. And why AI related? Because obviously the main growth in energy requirement in terms of electricity requirement is coming from data centers now. The second thing is lithium, and that has two parts to it, right? So if there is a push towards renewable, and that's a big if, right? Because this administration is not really that concerned with renewables. So if there is a push towards renewables, then only you will see extra demand for lithium, because obviously wind and solar comes in waves, right? So when the sun is out, obviously the power has to be stored. And to store it, you need lithium. Similarly, with the wind speed going up and down, so when it's high, you need to store the electricity, and therefore you need lithium for that as well. Number one. Number two is Tesla and batteries again. So if there is some pro Tesla policies, and then again there is demand for lithium going up because batteries demand goes up, that can support this as well. But this is not as safe as your industrials and energy, right? So materials is relatively riskier, unless you're talking about gold. So obviously gold is an outlier here. That is something that you can get exposure through Barrick Gold, or the ticker is gold for that. Newmount, also another very big gold and copper producer. So those are benefiting from the de-dollarization, the partial de-dollarization, which is central banks of China, Russia, India, etc. buying gold, and also uncertainty because of all of this reversal of globalization, right? So that, of course, is something that you should have in your portfolio. But when it comes to copper and lithium as materials, not as safe as your industrials and energy, but still a decent exposure to have. It's not much downside to it, right? So what's the conclusion here? So what we're saying is that, okay, you've got Trump administration coming in, and with this nomination, we see a shift in economic priorities, and those priorities are obviously domestic manufacturing, energy independence with fiscal discipline, right? So energy independence, again, you should look at shale, domestic manufacturing. I talked about industrial companies within the construction and agricultural space that are expected to benefit from all of this. with the higher infrastructure spending and the domestic incentives. Plus, something we've talked about many times, that this is expected to keep pushing inflation to remain stubborn, which might lead to interest rates staying higher for longer. And that, of course, is good for the financial sector. But I wouldn't say that you should go for financials, because in case the economy gets really weak because of all of this reversal of globalization, then the Fed might have to reduce interest rates. So that, even though the chance is low of that happening, but that is something that is there, right? So the safer option here is selected energy stocks, like we already talked about, and of course industrials broadly. But selection within that is also definitely beneficial. However, energy stocks have to be selected for sure, because there are winners and losers here, right? You don't want to go for those refineries which are based on sour crude, because that is imported into the US. So that doesn't sit well with the energy independence. Number one. Number two, apart from industrials and energy materials, and within that commodities, right? So we talked about copper, we talked about lithium. But again, don't speculate on the price of copper. Don't speculate on the price of lithium, because that is related to a global demand, and global demand for global demand for copper and global supply of copper. There is still more supply than demand, at least in the short to medium term. So yeah, longer term, we are seeing that copper demand will be higher than supply globally. But this is not about global, right? This is about US producers of copper and US producers of lithium, and demand of copper and lithium within the US. And then obviously domestic producers being preferred to take care of that demand. So that is in the case where electricity transmission networks have to be made, and batteries have to be made. So both copper and lithium should benefit, and companies that I have shared, which are local US companies producing copper and lithium, could benefit from that a lot. Plus, of course, inflation stays high, so you need to one way of doing that is to obviously position in financials if interest rates are expected to stay high. But the way I see this is that all of this uncertainty and disruption is good for gold. So you can position in gold miners like Barrick Gold, which is, the ticker is gold, and then you have Newmount, which is NEM. Right. So as always, if you found this useful, please like, share, and subscribe. Leave your comments. Any input is welcome, so that we can incorporate that into our process and share updates with you accordingly. So hope you enjoyed it this week, and looking forward to seeing you next week.